Welcome to Zen and the Art of Real Estate Investing, one of the fastest growing real estate investing podcasts in the world. What if you could learn from experienced real estate investors? Find out what got them to where they are now. Get insight into their daily habits and take these insights to inspire your own growth. Each episode, Jonathan Greene shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor and the founder of Streamline, a data-driven, investor-friendly, independent real estate brokerage located in Madison, New Jersey. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, this is the free mentorship program you can take with you anywhere. Now, here's Jonathan.
Thanks for showing up for this milestone episode number 300 of Zen and the Art of Real Estate Investing. It's honestly been an honor for me to do this podcast for so long, and I have no plans of stopping. So today you're going to get what you need to succeed as a real estate investor in 2026. Wait, I know it sounds generic, but what I did is I plugged that type of question into ChatGPT and it rolled me out 10 things and 10 questions that I had to answer. And I only looked at it for a second and then I just turned it on and record. So you're going to hear references to past episodes. You're going to hear what we're planning in the future, but you're going to hear me basically live answer 10 important questions that can help real estate investors do better in 2026. And I can tell you, I thought it was going to kind of be a baby investor version, and it wasn't. It was extremely high end. Get ready. It's go time. Episode 300. Thanks so much for listening. This is episode 300 of Zen and the Art of Real Estate Investing. And it's just me. You're getting a solo episode. A lot of times on these milestone episodes, I've brought on my friends. I thought I maybe have on 3 or 4 people. But then I realized as I started to get so many bookings, which were usually 10 to 20 ahead, I haven't had the need to do a lot of solo episodes. And the feedback I've gotten from solo episodes has been good. So episode 300, it's just me. It's a great milestone. Honestly, really crazy that we got to 300 episodes and we're still going really strong. I want you to know a couple things. One, I'm honestly so thankful for anybody who listens to it, whether it's one person, 100,000, 10,000, I don't know. Every single person that listens, I'm thankful for. Whether you're in Toledo, Ohio, Wichita, Kansas, Anchorage, Alaska, France, anywhere. I'm just really amazed that this medium is so exceptional that it can go anywhere and reach anyone. And potentially one conversation that I have with any guest could just change a little bit of the mindset of somebody's view on real estate investing. And 10 years later, they could be doing huge things. 1 year later, they could be doing huge things. So for episode 300, I wanted to do a couple things. I wanted to connect directly with you. You're used to me asking all the questions and guiding the guests through, and I've really been very pleased with our guest list through 300 episodes. If you've never been on our website, go to zenandtheartofrealestateinvesting.com. You can go to the guest directory, especially if you're newer to the podcast. It's a great way to see all the legends that we've had on the show. If you just started listening in the 200s, there's a lot of episodes all the way back to episode 7 and beyond, which is when we started having guests that could bring you a ton of value. The best way that I think if you start a podcast that's this far along and you want to gain knowledge from the old episodes, look for the keywords for things that you're interested in the title. And you can, browse the show notes, see what's there, or look for people that you've always wanted to hear. And I'm going to give you a good hour discussion with them every single time. So for episode 300, I was tossing around some themes, and instead I used ChatGPT. I used to not be a fan, and I've learned to use it for specific purposes that help me. And I think one of the 10 questions in there is going to be specific to this. But what I plugged in for ChatGPT was, what are the 10 most important questions that real estate investors in the United States want to know the answers to in order to prep for 2026 success? Now, I think it's important. I'm recording this on November 15th, around 8 o'clock Eastern time in the night. That's why it's dark. We've got some time. It's a Saturday night, and I'm bringing it here to you. So I got these 10 questions. I've barely reviewed them because I wanted it to be free flow. As a lot of you know, I was a trial attorney. I did more than 250 trials, and I did them without notes, really. I just used bullet points. I've never had notes for these. I send out a form to all the guests. They fill it out. I do my research in advance, and then we're just a full go. No show is the same. There's no scripted same questions. We just are a go, and I'm going to do it again tonight. So I'm going to read you the questions, and I'm just going to free flow and give you my answers. And a lot of those answers are going to be based upon things that I've learned from the guests over 300 episodes of this show. I've made some great friends, great connections, business partners, and I'm sure we'll get into it as we go through. I may not answer all the questions exactly the way they intended because I never know what's next. And I think that's what's the fun of it. If I'm being my own guest, it's going to have to be free flow as well. So thanks again for listening at all. Promise you this episode will help you in 2026. That's what it's about. This is the podcast about the mindful approach to real estate investing and your mindset. Mindset has been a huge lift for me in my life as it's changed and progressed and got more positive and more focused. It has helped me as a person, and that means it helps me as a real estate investor. Are you ready? Let's go. Number one, what is the outlook for interest rates, refinance risk, and debt recapitalization in 2026? So to me, that sounds like a very, very multifamily syndication question in general, because that's where we're seeing all of the refinance risk and the debt recapitalization possibilities. And I've had so many great guests in the multifamily sector that have talked about this. And I think that you're looking at a big problem coming up, which, of course, when there's a big problem, could be a big opportunity. Banks don't want to foreclose on these huge loans right now. But at some point, the rubber's going to meet the road. And those people who had short-term debt that was a bridge loan at a variable rate or at a high rate, and now the rates haven't come down or they've gone up from where they got it, and it's time to pay, or the balloon's up, the 5-year balloon's up, and they started at a 3, and now we're at 6.5 or 7. They are in trouble. So there's going to be a lot of different things that go on. But whenever when you ask questions like, what are the outlook for interest rates, or what's the outlook for the housing market, which is probably coming up next. But when it comes to interest rates, I want to be really specific about how I look at them. I don't care at all. And it's not that I don't think they're relevant. Of course, it's relevant, especially in large scale deals. They could change the trajectory of the whole deal if it doesn't work. But everything is a calculation in my mind. Although I'm an asset hunter and I'm really focused on the asset, interest rates is just part of the calculation. Historically, the rates are generally fine. And I think you'll find that there hasn't been that much fluctuation in the last year. And I don't see a ton of fluctuation in the next year. Do a lot of things come out in the news that come up with some interesting opportunities for some, like 50-year mortgages? Sure. I think you're going to see a lot of things that come up and a lot of things not happen. And it's really all speculation until it happens. To me, if you're a real estate investor, you're just always on the grind. Interest rates are 6, interest rates are 3, interest rates are 7. There's still deals to be had. A lot of my guests have said the same thing. The interest rates aren't really part of it. They're just part of your calculation to see if this deal works. Interest rates could put pressure on sellers, especially if we're talking about that debt recapitalization and refinance. And interest rates could put some pressure on buyers if they're feeling like, hey, now it's down to 6 instead of 7, and they're ready to deploy some money. But in general, I just don't think that interest rates are something that people should panic about. You, personally, just you, just me, we have absolutely zero control over interest rates. There's nothing that I can do today, tomorrow, or in 2026 that's going to affect interest rates. So all I'm going to do is decide what my current buy box is, which is what you should do for 2026. What's your asset class? What's your geography? What's your price point? What are your goals? What's your mindset around money? And if you do that, the interest rates are just kind of there. And you're going to judge each deal based on that. For all the people who've said, oh, I'm just going to wait for interest rates to come down, I say the same thing that I always say. Where's your crystal ball? How long are you willing to wait? And why do you know something that nobody else knows? Rates aren't going back down to 3%. I think we're all pretty clear on that at this point. That was not generally a good thing, although it was fun for everyone who got those refinances in. Now's just a little bit more regular. If you see a 5, I'd be doing a refi on that if I'm way above that. But, it's adjustable. A lot of people are sitting with the golden handcuffs because they're in that 2.5 to 3.25 interest rate on their homes, and that's having a big effect. But at some point, they're going to have to move too. So interest rates, I expect in 2026, I don't really expect to see much differential. Certainly not anything that's going to make a gigantic difference overall. So all I can tell you is keep your nose to what you're doing. Make sure that you identify your core values around real estate investing. Make sure your partner or anyone in your family who you're investing with, make sure that you're all on the same page. You can't really worry about interest rates if you and the people you're investing with don't agree on the strategy. Know your buy box, know your geography, like I said, know your asset class. You don't want to be a generalist. A generalist won't get anything done in 2026. You really want to start to niche down and focus, figure out what's going to work for you. Over the last year, I guess it's probably more than a year, over the last 18 months was my multifamily syndication time. That's when I dunked into 4 multifamily deals, 3 of them around 50 units and one's around 250 units. 3 are with one operator. That was from the podcast, Drew Brenneman of Brenneman Capital. I just keep going back for more. The other one from the podcast as well, Mike Roeder and Granite Towers. So my 4 syndication investments, which I never knew about before 18 months ago, are all performing. I've been paid on them all. Nothing's behind. And I think because I learned so much from people like Brian Burke and other people who came on the podcast talking about syndications, that I knew that my job was to investigate the jockey and then figure out, what type of asset that horse was. And these jockeys have done a great job for me. And I believe I'm about to invest into my 5th syndication, which again is going to be with another guest, 2-time guests, Deanna Osa and Josh Dobkin. And they're working on their 2nd wellness hotel. And I want to get in on that because their first one, Terra Palm Springs, went so well. So if you're hearing what I'm doing, you should be figuring out what you're doing. The other thing that I'm doing in 2026 for sure is short-term rentals. I'm sure you guys have heard the show. You heard me with my boy, John Bianchi of STR Search, just talking about what we're doing and what I'm looking for in upstate New York. And now I'm doing a lot of business as an agent in upstate New York. My license, obviously in New Jersey, I have my own brokerage that's Streamline. In New York, I work for Country House Realty, and I'm looking for weekend homes for clients, short-term rentals, and if you want to move up there, got you covered as well. But I'm definitely going to get into one short-term rental to get my feet wet again and start playing around in that sandbox. Number 2 from ChatGPT, how tight is housing or asset supply in the target market, and what is the demand driver? Yeah, I mean, these are pretty wide scope questions, so I'm going to take them the way that I want. So one thing that I'll say, and I know it will come up again, when we're talking about housing, it's kind of ludicrous to talk about national housing. In general, national housing, we know we have a housing shortage. Everybody knows that. Multifamily was stalled. We're having some interesting times in figuring out when those things are going to get online, how many excess houses we need. It's a lot. We're well behind in the housing for a lot of reasons, but I don't think for me, that's not what this is about. And I can't, give you advice on 2026 about the housing market. I'm not an economist and I don't study that type of data every day because I don't work that type of business. But what I would say is if you want to understand housing, start local. And focus on your buy box. Like I said, wherever your geographical buy box is what you want to study. And you'll need to study the absorption rates there, seeing how quickly things are selling to really understand where the line is. Is this a buyer's market or this is a seller's market? I'm still in New Jersey and everywhere around me is still a seller's market. Are we seeing some things get a little bit better? Honestly, not really. There's very little inventory. There's high prices. Things sell way over asking. Sellers have not come down. And to be honest, they haven't had to. So it's been kind of interesting to see, especially on flip deals. If I'm looking and I'm like, I'll bid and I'll come in fifth out of 10 and I'm at my top and I know the numbers. So I feel like somebody's going to get soaked, but prices and values keep going up. So I think to understand the housing supply in the target market and what the demand drivers are, to me, demand drivers, that really is going to apply to multifamily. Demand driver definitely applies to something like self-storage and industrial flex, depending on what you want to do there. And I really like self-storage as an asset class. I'm interested. My friend Ryan Goldfarb, prior guest on the show as well, we made 2 offers on self-storage, lost them both. Then we kind of took a break. He had a baby, so he's a little busy. But I really like self-storage. Every time I do a self-storage show, I hop off and I'm like, why aren't I doing this? No tenants, no toilets. Sounds great. You can just lock people out. So self-storage is something I'm interested in on the small scale as well. And I think that's where demand drivers are really important, especially for traffic patterns and what other storage is in the area. If you listen to my episode with Bree Hartman not that long ago from Self-Storage School, she talked in depth about how easy it is to find storage just by going on Google Maps, looking at the reviews and kind of seeing what's out there. So you can go back and listen to that episode as well. I think your locality is what tells you if the housing market is tight or if it's a little bit looser. Great for you if you're in a looser market. Florida obviously has been looser, more inventory, things are sitting longer. New Jersey, not so much. But I think, again, like I said in the first question, if you just keep your nose to the grindstone and you keep looking every single day in your buy box, in your geography, at your asset class, deals come up. You just have to stay at it. So 2026 should be a consistency play for you. A lot of people say that I'm the most disciplined and consistent person that they know. Maybe it's just because I like to do the same things. I like to eat the same things. I like to have the same schedule. I have a very detailed schedule. But if you can upschedule yourself a little bit in 2026 and just lock away 30 minutes, 15 minutes, an hour a day where you know you're going to be uninterrupted and you keep to it and you do your research on your target market and what you want, you won't have to worry about these questions because you'll know everything that you need to know. If you have a real estate license, there's no reason why you shouldn't be looking at the hot sheets for your asset class every single day. See what sold, see what new stuff came on. I do it for every single city and county that my clients are interested in and that I'm interested in. I do it every single night. Because if I do it every night, it's not that overwhelming. It takes 10, 15 minutes. If you're doing commercials, it's going to take like 3 minutes. There's going to be 2 or 3 new things in your town. You want to be the person who knows about them. Number 3, which property types and geographies are likely to outperform and which may struggle in 2026? Boy, good thing I've had on so many great guests. I think office is going to still be on the struggle bus. I guess it's the way that you think about it, though. I mean, Scott Trench, former CEO of Bigger Pockets, former guest on this show, he's looking to buy office. I think he actually did buy office in Denver. And the office play could be interesting, even if you're not going to try to do something different with it. Are people going to go back to the office? Yes, they have. Are businesses going to work better possibly out of an office again? Yes, offices provide a lot of great things, camaraderie and workforce companionship. When I was a prosecutor for so long, it was the best. I mean, we used to go out to lunch every day with like 5 or 10 of us. You were always talking, you're always watching and seeing what each other are doing. And that's kind of evaporated now. If you look at all of the businesses that have stayed remote and people say, oh, it's great. I'm getting so much done. We're still having a loneliness epidemic in this country. So I don't think that retail is a bad play. I just think if you're buying in too high, it doesn't really make any sense. So, it's interesting to go through these questions because now as I'm talking through with myself and you, kind of like retail. I mean, I obviously like small retail. Small mixed use has always been my bag, even though all my deals on them fail. I think that's a huge asset class that your kind of newer investors should be looking at. Main Street mixed use, 2 retail, 2 apartments on top, 1 retail, 1 apartment. It's just a great asset class, and it would be great to just bring back main streets in your town. I think it's a really important thing to do. So that's just kind of an asset class that I'm on. I think self-storage is going to continue to perform if you're doing it the right way. the larger scale, I still think they're okay. If you're not, looking to sell to a REIT, I think you can really capitalize and do well because it's just a matter of mining the data and knowing who else is in your marketplace and who you can beat. I think there's obviously, if we're talking about scale, data centers. I mean, is there an AI bubble? Yes. If you look at the financial implications of AI and how all the money is just going back and forth between these 5 or 6 major players, that's pretty scary to me. But do I think that there's money to be made in building data centers? Yeah, I think we're going to need that. We also need more energy. So anything that comes to solar is going to be important. Just released a great show. Actually, the show right before this was a show on EV infrastructure for multifamily with Benjamin Canner. So yeah, I think data centers is a big play. I still think debt funds are going to be good things to invest in. The smart people who understand what they're doing with that, I think they can do well. And look, multifamily is always going to be good. Why? We need housing. It just depends on what you're investing in, who you're investing with, and what your expectations are for that. So, I mean, I'm not a prognosticator, so I don't know what's going to happen in 2026. And like I said, for number one, I just keep my head to the grindstone and I'm just keep pushing, looking at asset classes, trying to look at something new, get back into short-term rentals and get moving. Number 4, what are the tax and regulatory changes on the horizon and how will they impact deal economics? All right, ChatGPT. These questions I can't answer. And again, I think this is just like hopeful. We really don't know. There's no way for you or I mean, unless you're somebody who works at ITR Economics, great show that I had with Lauren Seidel-Baker. That's a great show to listen to. Because welcome 2030 is coming and it's not going to be good. So there's a lot to do before that. So I highly suggest you listen to that show and what we say about 2030. Regulatory changes are really up and down. Obviously, a lot of stuff comes out with the current administration. It doesn't all come to fruition, but there's just a lot of material out there. So I don't really react to the material when it hits the news. Again, I don't read the news at all. Now, all I do is I get the email from New York Times every day, and I do look through the highlights. I want to make sure I'm staying informed and even more informed than I have been. But I don't sit around basing my investment strategy on things that I see in the news because I'm either going to be well behind or it's not even going to come true. So, I mean, for tax consequences, obviously, bonus depreciation coming back is huge. The STR loophole is huge. We talk about it on a lot of short-term rental shows, but it's complicated. And I think for tax consequences, real estate professional is going to become more and more a thing. But you really need to know what you're doing, work it out with your tax professional so that you're doing it the right way and you're making sure that you're logging everything well. Deal economics, I'm going to go back to say the same thing that I said in the beginning. Look, what goes on the spreadsheet is part of your calculation. You still want to be a good tire kicker also, which is what I am. I'm a better tire kicker than I am at building spreadsheets to show me what I'm going to make for the next 30 years, because that could all change with some type of economic adjustment. Weather anomalies could change that. So I like to touch, feel, smell, look at the asset, look at all corners of the asset, make sure I've got it. Number 5, what is the exit strategy and how realistic is the timeline? So that's a fantastic question if you're a limited partner or want to be a limited partner and you're looking to invest in syndications. Let's just take multifamily, but we can take any syndication. Some might be longer. That's an exact, if you just quote that question, that's one of the first questions that you should ask general partners. What is the exit strategy and how realistic is the timeline? It's very, very important. So for my syndications, I've known when I invest as a limited partner in syndication, I know that I'm leaving that money there. I don't need the money. I can't get the money. So I have to be comfortable putting the money in and waiting. And so far, it's been fantastic. And I know I'm going to do really well on them. But when they go full cycle, what am I going to do? Probably just going to 1031 or put the money right back into something again, because it's working well and it's a legacy play for my kids. It's also been interesting for me to understand what their exit strategies are, if there are exit strategies. And that's something that's very important. If you're buying something and you're doing an operational turnover, the exit strategy might be different. If you're doing value add, of course your exit strategy is going to be different. Your value add is always build it up, raise the revenue, make it a much more exciting product. Probably get that into the doubled range, and then you're going to sell it off to someone who wants to buy a fully operational asset in that asset class. So I think exit strategy is important, but let's go all the way just to your regular investor. If you're going out there and buying single family homes right now, or just small multifamilies, you really need two exit strategies. So if you're a house flipper, you still need to have a backup plan. Are you going to be okay if you have to rent this? What if the market turns? Can you be at least break even if you rent it for a little while and wait the market out? A lot of guests that I've had have had to just kind of rent it and suck it up for a while, and then eventually it will come back. So I think it's important. Now, if we're talking small multis, I think your exit strategy is also just as relevant as your income strategy. So we've talked about it a lot, 2, 3, 4 family. What can you do with them? You have so many options right now. Long-term rent, mid-term rental, short-term rental. They'll really work in most markets if you do it right. I love midterm rental in a multifamily. I just think it's a great idea. If you go back to my episode with James Huang, great guy, young, and him and his company at Stellar Housing are just crushing it. They probably have almost 30 midterm rentals, a few on arbitrage, a lot owned, and they kind of mix and match what they do, but are really becoming experts in that MTR space. And I think you can do that when you just imagine you have a 3 family. The perfect scenario for a 3 family is 1 long-term renter, 1 midterm renter, and 1 short-term renter. Why? Because you're really diversified inside one asset. Might those all collide at some point? Sure. But you have 3 different options to play with. Maybe if you don't want as much upkeep, you go for 2 long-term renters and you do 1 midterm rental and you see how it works out. But you have the option to play around with these strategies, because remember, if you do midterm or short term, you do have to pay for the furniture, but those guests end, your bookings end at some point. So you can just stop the booking and turn it into a long-term rental. So it's not as tied down as your long-term rental where you're waiting till lease end. So that's just another tidbit on exit strategies and timelines. I think you should really figure out. If you're a flipper, you're always, want to know what your timelines are. If you're a good flipper, your timelines are going to be super tight. Dave Meyer just finished his flip in Seattle with James Daynard. And looks like it's going to be awesome. Can't wait to see what it sells for. But even with Dave's experience, that was his first large scale flip. Looked like it ran right on a very good timeline because he's using someone like James, who obviously done like 1 million flips, knows what he's doing. So if you're a brand new flipper, you really have to be careful. Always calculate you're going to spend twice as much and it's going to take twice as long. And I think you'll be a little bit safer like that. All right, that was number 5. We're going to take a brief interlude. And the one thing that I'll tell you on this brief interlude is I'm thinking about doing retreats in 2026. Maybe 1, maybe 2. I've seen my friends do them great. I learned a lot from both of the women at Wire, Grace Gudenkoff and Amelia McGee. Their retreats look awesome. And Wire is Women Invest in Real Estate. And I just look at that and I'm like, that's something that I would want to do. 1, I'm an introvert, so I don't really want, masterminds are a lot for me because I have to keep showing up. But retreats are cool. You pop in for the weekend, you pop out, make some relationships, and then I can take like a week to 2 weeks to power down. So I am working on some ideas for that. I think that's going to be really interesting. Talking about some live podcast group episodes, which I would think are more kind of like live streams. That's something that I hope will be interesting too. We're trying to kind of adjust and do things a little bit differently in 2026, add some new things to the mix, and obviously grab some new guests. So if you've been a listener and there's a guest that you want to hear who you haven't heard and you look in the guest directory and they haven't been on, just send me a message through the website. Happy to look that up. And yeah, look, this has been a great voyage for me over these 2.5, probably almost 3, probably more, probably 3.5 years now. And I just look forward to adding more to the brand of Zen and the Art of Real Estate Investing, which PS is trademarked. So I own the trademark on that. So it makes it easier for me to expand and do other things. we do have some really big plans that are long-term thinking that really help focus a lot of this educational aspect on middle schoolers and high schoolers, because I just really think that they could benefit from this. I grew up with a dad who was telling me everything from the time I was a little kid. And I feel like a lot of people are missing out on that, because you need to have some alternative plans out there. And there's real estate everywhere you go. It's under every business that there is. There's just real estate everywhere. It's something that they should be teaching in school, college, everywhere. And they're not in general. So we're going to try to bring that to the forefront as well. NPS, we do meetups still in the state of New Jersey, first Wednesday of every month. You can find them at zenandtheartofrealestateinvesting.com. Go to the events page. You'll see them there. They rotate locations, and it's a great way to just meet up, get some confidence, see people who are just like you doing the same things that you're doing. I think it's the easiest way to beat the facade of analysis paralysis. All right, let's get back to it. How resilient is the cash flow under stress? That means vacancies, higher expenses, cap rate shifts. That's like, see, this is interesting. I've been investing my whole life. That one's like very much above my pay grade. I feel like I would need to call in all of my multifamily syndicators, industrial, flex, everybody. How resilient is the cash flow under stress? Vacancies. So on vacancies, I can just tell you from the shorter view, if we're having a housing shortage, vacancies should be lower, but it really depends on what type of product that you're talking about. My syndications, I think 3 of them are 100% occupied, and I think 1 is usually between 90 and 94% occupied. So we're not seeing any issues there. I think higher expenses are always something to look at. I think if you own condos or HOAs, yikes, that's something in 2026 I'll really try to get rid of if you can. There's just so many assessments, so many HOAs going up, which make them impossible to sell later. We've just seen hamstrung values, many more problems in getting these things approved. It's just been kind of a slowly messier situation after that apartment building fell in Florida. I don't want any part of HOAs, condos, or townhouses. I just don't. And I think you'll see higher expenses there. HOAs are going up all over the place to astronomical amounts where, I mean, just from my experience, I go to Jersey City a lot. You'll see a building there where the HOA is like $650 a month and there's literally nothing. There's no amenity. The HOA is for building maintenance. So you're looking at HOAs that have higher expenses. They can't maintain them. That's a big one to look out for. Rate shifts, again, I don't deal with a ton of commercial. I've talked to so many people about commercial real estate here. So they're always going to be better to ask. But, insurance is still going to be an issue on your higher expenses. It's something to watch. Make sure that you're very clear on that. I think your experienced operators have providers that are always giving them the best deals. And you want to get to that part. If you're new, you kind of have to pay the new person tax, or what we would sometimes call the idiot tax. And we've all been the idiot. So I'm not calling anyone an idiot. Sometimes I still am, and I have to pay the idiot tax because I make bad decisions. But, when you're new, you're going to have to pay that tax a little, same as a contractor tax when you don't know what you're doing. But you just want to get as many reps as possible. So getting to more meetups, starting to ask better questions, take these questions, ask people that you know in the multifamily game, on your large scale syndication game. I think that's what's going to be important for you. It says in there, costs are rising, materials, labor, maintenance. Yep. Tariffs have had an effect, but look, the tariffs go up and down all the time. So to me, it's the cost of doing business, but I'm not a GP of a gigantic multifamily value add where a change in the lumber price could change the entire cost of the job. So small scale, I don't think it's as much to worry about, but I would worry about insurance. And please listen to me on these HOAs. Watch out. If you own a lot of condos or townhouses, like I said, I would be trying to get rid of them. Just my personal opinion. Number 7, am I positioned for where capital is flowing and where it is withdrawing? I'm going to take that and adjust it a little. I think that if you're looking for where something is going to change, I always go back to my experience with local real estate investing. So it says here what to ask. Are investors flooding this market, driving prices up? That's important. So let's talk small scale for this one, because I have talked kind of larger, bigger deals for them all. I think if you want to position yourself in a market that's going to grow and you're not in an insane state like New Jersey, where the appreciation rates are just like bonkers every single year. I sent out, I have a client who bought 3 years ago in Livingston for $750 and they're at 1.5. That's 3 years double in value. That's crazy. But if you want to be in the path of progress, you have to be someone who is driving. And one thing I was going to talk about sometime in this soliloquy was that what my dad did and what my dad taught me to do, you can still do. And this goes to where you're positioning yourself. The only way to know the neighborhoods isn't from going into Facebook groups and looking on Google Maps and scrolling through. It's actually driving the areas that you're interested in. It's a little bit harder if you're an out-of-state investor, but I would hire a driver to drive the areas and send you photos that you can match up with Google Maps. If I'm a local investor, I'm going to know every block better than you. And that's how I'm going to get the deals. I'm going to be able to sniff out where the path of progress is. For me, if I start seeing, look, of course, there's always a Starbucks, your Sherwin-Williams, Benjamin Moore, Home Depot, all of these things that are big indicators. But most of us don't know that before the sign's already up. But look, if you see the sign up and they're still doing a build out for 6 months, that's a good sign. Why? Those companies have way more money than us. They spend way more money on demographic research and the path of progress. So if you want to be in the path of progress, get where they're putting cool new stuff. For me, I personally, if I'm going back to my kind of mainstream mixed use thought, I like when I start seeing independent restaurants pop up. Now, what does that mean? That means the rents are going to be pretty cheap to start, unless it's like someone from New York City going to Catskills and opening a restaurant. They probably have money, but restaurants are, that's a tough business. So I like to see that, because I feel like that means if you're going to get a groundswell, if you see a couple things going on, that's a great time and a great town to focus on. Near me, I just look at Boonton, that's Boonton, and I'm like, this town is so cool. Why does nobody talk about it? It's hip, has art galleries, tattoo, coffee, lots of independent restaurants, not a lot of chains, has a cool vibe, windy streets, hilly streets. I look in that market all the time, haven't scored anything, but yeah, I like it. And I look at the Main Street real estate there all the time. So I think, if we're just talking what the question was asking, where capital is flowing, I kind of adjusted it for, where the interest is flowing. And again, if I go back to, if you're doing your daily research on the market, whether you're a licensed agent or not, and whatever you have access to, even if you're just using Redfin, you should be just looking at everything new. And you want to be looking at the prices. You want to see what the dumps are selling for, and you want to see what the out value of those dumps are selling for after they're flipped. That's going to tell you a lot about the market. You don't want to be the last one into a market. It was like when Austin got hot, and then Austin was hot for 5 years and it's still showing up on lists. It's like, no, you're 5 years late, and now a lot of people are paying the price on that. You don't want to be where everybody else is. You want to get somewhere before everybody else gets there, not before anyone gets there, because that's going to be a little more risky. I might try that. But again, also, if you want to be a good single family home buyer, that's how you do it. You buy in the next neighborhood that's going to pop. And honestly, if it doesn't pop, you're probably not going to lose money. This is America. The price is just going to go up, unless you made a drastic error and missed something along the way. Well, this one plays right into the entire point of this podcast and my life. Number 8, how well do I understand the mindset piece, the behavioral, risk management, and psychological side of investing? Thank you, ChatGPT. This is right up my alley. And this is really, honestly, I was going to do a whole episode just on this. But I want to be clear. We've talked about it in some shows. Listen when I tell you this. If your own personal mental health is not in the best place, if you're struggling, if you're going through a divorce, if you're sick, if someone in your family's sick, if your child's not doing well, if she's having issues in school, if there's things going on, do not invest your money into things that you don't know about. You don't want to become a house flipper while you're going through a divorce. You don't want to invest in a multifamily syndication when you're also dealing with a sick parent. Please don't. If you're having mental health issues, look, this is something we should talk about. It's much more prominent now, and in a good way, because people are paying attention more to their mental health and they're trying to struggle less. But if you're struggling, don't invest. You have to be at your best to invest. I mean, maybe you're not always going to be at your best, but mentally, you want to be in a very, very good spot when you're going to start buying things for $500,000, $1 million, $1.5 million, or you're just going to put $100K into a syndication. If your mind isn't right or your life is messy, it's not a good time to invest big chunks of money into real estate. It's not a good time to take a guru class. You're not going to pay attention. It's not a good time to just go on webinars and try to listen when you know you're going to be getting texts, because there's just a lot of stuff that's going on in your life. You don't have to rush to the finish line. My dad always said, don't rush life. Again, this came up a lot when I was driving, when he was teaching me how to drive, because I would miss a turn and just start cursing uncontrollably. And he's like, what are you doing? You're 16, you have a permit, you can't get anywhere. So what are you in such a rush for? What do you have, a date tonight? You can't even go anywhere. And he was right. And I'm telling you the same thing. Don't rush life. Don't rush to get to retirement. You need to build a foundation, and don't rush yourself. If your mental health is not good, do not invest. Work on yourself until you feel confident and steady and the other parts in your life are solid. Sometimes that means you're going to pump the brakes. You still got to go to your job, but this is your side hustle or your side job or your side investment. And that means there's even less time for it. So please, if you take one thing in 2026, pay attention to your own personal mental health. Make sure that you incorporate the things that you want to. For me, that's meditation, exercise, reading, mindfulness. I pay a lot of attention to my schedule. I keep very strong boundaries. As everybody knows, I don't answer the phone. I don't talk on the phone. It's just, that's my non-negotiables. You should have your own non-negotiables, and you should work on those with your family. And no matter what, if you're in a relationship, if you have kids, you should still prioritize some solo time with yourself. Because if you do that, the mindset piece for your investing is going to be so much better. This is what this podcast is about and why I started it. I changed my mindset about 8 years ago. It helped me adjust the way that I invest. I invest totally different now. I'm never in a rush. I don't make bad deals. I could care less when I lose a deal after I make an offer and it doesn't work out. It just doesn't matter to me. My job is to try to be the happiest person I can, be a good person, and hopefully bring good things to the world, some of it through this podcast. But in 100 years, nobody's going to know who I was. No one's going to know who you were either. Not even your great-grandchildren might barely know you. I don't know that much about my great-grandparents. I always look on Ancestry and I'm trying to build something more so I have more of a background. But we're just not that special. And that shouldn't make you feel bad. It should make you feel free. Get to work, take care of yourself. And when you're taking care of yourself, your investing decisions are going to be all that much more sound. And that's the psychological, behavioral, and the risk management part of real estate investing for 2026. Work on yourself. Your investments will come. Number 9, what technology, data, and analytics am I using to gain an edge, and how is that evolving? Well, I think, if you just look at what we're doing now, I built this list from ChatGPT, something that I was very averse to in the beginning, but now I'm finding the best ways to use it. For short-term rentals, I use it every single day. Once I see a property that comes up, I immediately say, how in the same chat, I keep the same chat on short-term rentals. I say, how are the regulations in this area? And then it breaks it down, and then I'm going to go on the town website, see if it's correct. And then if I myself am going to make an offer or a client's going to make an offer, we call direct just to make sure, because in the towns where I'm working in upstate New York, they have caps and limits in some towns that are full. So it may say that it's short-term rental friendly, but then they only have 70 licenses and all 70 are out and there's a wait list of 52. You're not getting a short-term rental, unless they're allowing those permits to pass or grandfathered. These are things that you have to do. And that could be a huge error if you buy in a place and then restrictions are in place that you didn't know about, your agent didn't know about. So I think ChatGPT is, kind of step one of what we're doing. I'm not a big fan of AI just in general. I think of ChatGPT as more like Google to me. It's just a better version. It's answering my questions. I don't talk to it. Like, it's not my friend. I'm not having a relationship with my computer. That's just not for me. I don't talk to it like it's my friend. As I said, I just ask questions, get the answers, and it's just like a very much enhanced Google for me. However you use it is great, and I've gotten some great people who have created their own their own ChatGPT for investments, and I've plugged stuff in there. It's pretty incredible. You can do just short-term rentals on regular ChatGPT and give them all the information. They'll tell you what your returns look like for sure. And P.S. we are in the process of starting the idea of taking all the episodes from Zen and the Art of Real Estate Investing, dump them into an AI, and then have a Zen and the Art of Real Estate Investing AI that can answer all of your questions. Might we get that done in 2026? Yes, we might. And that's the collective minds of now, at this point, 300 different guests, probably a little bit less, but we've had a lot of 2-guest episodes, so probably about 300 guests. And we want all their minds working together because it's such a wide scope. Every asset class, every type of thing, every background story, we want to boil down and get you. And that, I think, is a great and smart way to use AI without being too crazy about it and letting it run your life or making it be your best friend. That part just doesn't work for me. So I think that's going to be big. And I think you can use it for a lot of things too. Just like I say with spreadsheets, it should just be a vetting mechanism. You should still be doing a lot of that due diligence yourself in person, on site, and matching up to what they're giving you. Number 10, how diversified is my strategy? This is right on to what we were talking about before, by asset type, geography, investment vehicle. This is great. And this is the last question. So diversification is so important for your portfolio. If you've heard a lot of episodes, you've heard I've always been a stock investor. I invest heavily in index funds. I just leave the money there. It churns. I'm probably up 17% this year on index funds. That does the job for me. I take other money and I invest in syndications. I know I'm not going to touch that. I have a play stock account where I just play because I've always been good at stocks. I'm usually up a good amount in that. It's not a ton of money. It's kind of like a play game. I have very limited exposure to crypto, no exposure to gold. And my real estate holdings are soft now compared to what they have been through my whole life. My sister and I sold off all of our shared assets except for one. So we don't really operate that kind of family office, family partnership anymore. And I've slowed it down. I've made syndications my portal, and now I'm going to start building up more assets. In 2025, I bought my daughter her first house. That was something that I really wanted to do, and I'm excited about that. She's loving it. And I'm looking for a short-term rental is probably going to be my next purchase. But I look at stuff in New Jersey also. I look for commercial assets and mixed use. Like I said, Main Street. So I think that you should be diversified. Yeah, real estate, you can be completely diversified in real estate. So you don't have to be investing, with a Merrill Lynch person or whatever. I use creative planning. That's just what works for me. But I think diversification is important. And I think so there's geographical diversification, which is good, but there's also clustering, which is buying a lot of properties in the same area, which is good. But I just wouldn't own all properties in one area. It's nice to get 3 or 4 in the same block. So you have a lot of appraisal issues that you can counter on your own. And if you're doing midterm rentals or short-term rentals in a short distance, you can always flip-flop people from place to place. I love clustering, but I still think geographically you want to be diverse. And if I look at how I've handled my portfolio, just going back to my syndication investments, I've talked about this on a lot of shows. I have exposure in Chicago, Madison, Wisconsin, and Dallas over the four deals and almost 500 units. And why is that cool? One, I don't want to operate multifamily, so I'm not operating. I'm just an LP. I'm just reading everything every month. And I really think I learned a lot about how to operate multifamily. I still don't want to do it. But I have exposure to geographical areas that I like and that I'm interested in. And that's why I like doing that as part of a syndication. I don't have to do anything. I'm not putting $1 million of my own in. I'm putting in 50, 100K most of the time and seeing what happens. And that geographical diversification helps me feel good about my portfolio. And it makes me feel like I'm doing a good job and I'm spreading stuff around. Would I like to get into self-storage? Yes, either on my own or in a syndication. Yes, I like that. I like that asset class. I think it's smart play. I've owned industrial. I like regular commercial. And when I'm go back to what I was saying about retail before, kind of liking the idea. I just miss going to an office. And hey, now with my new office for Streamline, my data-driven, investor-friendly, independent real estate brokerage in Madison, New Jersey, I'm going to the office every day now from 10 to 4, soon changing to 12 to 5. And it's helping me a lot. I still don't talk to that many people, but I'm in an office. I'm looking right out at Main Street every single day through 2 huge windows. I'm getting a lot of natural light. It's good for my mental health. It's good for my personal health. And I'm out in the world. It's just better for me as an introvert to be there. So, that's part of it. And I think so if you're looking for a diversified strategy, I just would, just don't go all in on one asset class or one geography. Just spread stuff around slowly. They don't have to be huge investments. That's why I like syndications. It's just, I can take 50 grand and just put it into something that is in another area that I'm never going to go and invest in a one-off there. And I don't really want to own 3 or 4 families in an area that I'm far from. It's just not my thing. So I am very heavily invested in terms of my time now in upstate New York, and that's looking at a lot of different assets, short-term rentals, weekend homes for myself, commercial assets, because it's drivable. It's 2 to 2.5 hours each way when I go. I do it every weekend there and back. I like it. Great drive, great scenery, great towns, cool independent stuff. Lots of cool stuff out there that I don't think that we have in New Jersey. So just figure out in 2026 how you want to diversify. If you're sitting on 42 units and that's between 7 different multifamilies, maybe just think how you want to branch out if those are all within maybe 30 miles. That's great, but don't keep doing the same thing. Just branch out with something a little bit different. And I've talked to a lot of syndicators who are general partners, and guess what? They're all limited partners in their friend's deal because they know that syndications work. So for someone who does multifamily syndications, they, instead of trying to do self-storage as a GP, they'll invest in their friend's self-storage fund or a self-storage one-off syndication as an LP. It's just a smart thing to do. You're going to hear an episode soon about buying your second home first with Katie Klein, who has been on the show. She used to host Sweet Success. Now her new podcast is actually called Second Home First. It's going to be probably 5 or 6 episodes, 7 episodes after this maybe. And I think that's going to be another play for people on how to diversify. Instead of buying their first home for themselves, they're going to buy an investment property first. She did it. I think it's smart. I owned way more investment properties before I bought my first home. I probably had owned 20 or 30 investment properties, obviously through a trust with my dad, but that I knew about and played around with before I was old enough to go and buy my first home. This is what I'm looking forward to and things that I think might help in 2026. I'm glad that ChatGPT could work for this. And I think it's clear I don't have the answers to everything. I didn't even know these last few questions I hadn't even gotten to. But I hope this is a good primer for you in 2026. If I could give the overriding highlights, number one, take care of your mental health. Make sure that that's in a good spot because you're never going to make good decisions if you're not in a good place. That's honestly the most important thing for you. It's the most important thing for your family. Make sure your family's all good. Make sure every person who's investing with you in the same deal is on the same page. That will just cause strife. Make sure you choose your partners wisely. If you're investing in syndications, really, really investigate the jockey first, then look at the asset. All PDFs look good. No one's ever going to send you a PDF for a deal that looks terrible and has bad IRR. That's never going to happen. So they all look good. It's your job to figure out what is good underneath the hood. And in 2026, I think this diversification part's really important. And I would say, don't get overwhelmed by the news. It's going to be another fun year of news cycles with a lot that's going to happen, a lot that's not going to happen. You don't have a crystal ball. I don't have a crystal ball. Most of the stuff on the news is hyperbolic. You need to stay grounded in your daily research and your daily routine and looking and staying with your buy box and then adjusting your buy box if it's not working for you. I wish you the most success in 2026. And for me to you, 300 episodes in of this podcast, I couldn't appreciate you more. The podcast is an homage to my dad and everything he taught me. But I don't talk about my mom enough. My mom was a single mom. I lived with her during the week. I went to my dad on the weekend. But the reason you don't hear as much about her is because she passed away when I was 20. My dad passed away when I was 33. And I do this podcast now at age 54 as an homage to both of them, because I know it would make them proud for me to just impart knowledge that they gave me. And hopefully it helps you. Like I've always said, if you get one tidbit from one show and it changes anything, that's amazing. And I'm just honored to be able to bring that to you. So that's it. Episode 300 is in the books. Look forward to another 300. I'm Jonathan Greene. We'll see you next episode. Hey, it's Jonathan. Thanks for sticking around after episode 300 so you can find out who's coming up on episode 301 of Zen and the Art of Real Estate Investing. Crazy. 301. It's Marcy Sagal of MSA Interiors, an award-winning design firm known for delivering innovative design services nationally and abroad. We're talking multifamily housing, senior housing, affordable housing, student housing, hospitals and healthcare, data centers. She does it all. This is a wide-ranging episode on design, but it goes to multifamily, and you can tie it back to every single project. It's an interesting show. I can't wait for you to hear it next episode.